San Antonio, and you have some secondary markets that are in between those that greatly benefit from that transportation. From an employment perspective, they become very desirable locations for large employers that need to service those markets. There's a lot less competition. Most everyone's focused on the larger markets, and so your ability to find deals and not have to beat out other people, that becomes a significant advantage here for secondary markets. And these markets are more affordable. And now rents tend to be between 5 and 10% lower in secondary markets than you'll find in the primary markets. Home prices often can be even more of a discount from that in the primary markets, depending on where you're at. And so these areas become desirable for those that are seeking affordability, um, proximity to maybe some larger cities, but are comfortable with remote work and a little bit longer travel, as well as more community based uh, values in these markets. So we see that a lot of these secondary markets are growing because of that. Now, weaknesses for secondary markets include average medium liquidity. So depending on the market that you're in, you're not going to have quite as many buyers and quite as many investors or lenders willing to service that. A great example of this is I have a 388 unit development site I'm raising money for right now in Waco, Texas. Well, anyone that lives in Waco would see this location and they would know this is a fantastic location because of where the growth is heading in that area where people want to be. But if you're a New York based lender that's looking to loan $60 million for me to build this, you're not familiar with Waco. You see this location and how small the Waco market is, the fewer comparables. Well, those lenders are 9 times out of 10 going to pass on that opportunity. And so that's a weakness because you have less available capital to you and less available buyers if you needed to exit quickly. And then wider market variation. This is not all secondary markets act the same. For example, Tyler, Texas versus Waco, Texas. Both are good markets, both are growing, but one is growing significantly more than the other. And one might have significantly more quasi institutional interest from an investment and acquisition standpoint than the other. And so I might underwrite those two different opportunities very differently, even though they would be perceived as secondary markets. So you just have to be a little bit more disciplined and careful about how you're underwriting secondary market investments and where you're willing to go. Then, lastly, here we'll move on to tertiary markets. These are going to be the smallest cities, like I said, average between 20,000 in population to all the way up to 150,000 in population. They're usually a lot longer distance from the primary larger cities, so they're not as easily serviced um, by those locations. These markets are going to be best for hands-on operators. So if I live in a market, a town that has 30,000 people, um, and I want to invest locally there, I'm going to find some great opportunities that other people that live outside of my city are just never going to find. Institutional capital is very rarely ever going to look at these tertiary markets. If you live in a larger primary or secondary market and you want to invest local, you're going to stay there as opposed to going elsewhere. And so the best opportunities for tertiary markets are those that live in and around that market, are very familiar with the market, they're experts there, and they know what the needs are of their local community and how they can profitably meet those needs. So tertiary markets, strong opportunities for local investors. They also tend to be high cash flow markets. If I come into a town that's got a population of 20, 30,000 people in it, 50,000 people, um, well, there's not a lot of buyers. If you have an asset that you're trying to sell, let's say 100 units, you're trying to sell, there's not a lot of buyers that live in that community that can afford it. And there's not a lot of buyers outside of that community that want to invest in the community. And so that creates an opportunity for those that are savvy investors to negotiate great purchase prices for assets in those markets. And if you can negotiate great purchase prices, most of the time, that market is also not going to be able to support new development with the rents in these tertiary markets, which tend to be very affordable, low rents. And so you get great purchase prices based on the income that you're receiving, but you also have low competition as far as future apartments that are going to be introduced in the area. And so those that live in the community have no choice but to rent from you, and so you start to see low turnover, low vacancy rates. All things are great for long term investments from a flow play. So those are strengths of the tertiary markets. Weaknesses is obviously very limited liquidity. So if you ever wanted to sell that asset, you're going to have to work really hard to find a buyer to replace you. Concentration risk. So if you live in a small town, um, for example, in Florida, and you're heavily invested there, and a hurricane comes over, uh, well, you're at risk of losing most of your portfolio overnight, as opposed to if you have different assets in different cities, that's going to be a much better protection for you. So if you're investing in tertiary markets all in one, concentration risk is a significant issue, especially if you live in an area where uh, there are circumstances that could occur that would wipe out the demand for the asset that you're investing in locally. And then less reliable demand. Let me put it this way: if you're in a town of 30,000 people and they have their largest employer, let's just say, employs 5,000 people, right? Well, what happens if that headquarters or whatever facility that is all of a sudden goes out of business or moves locations, et cetera? Well, now you have a massive shift in demand for this market, and you risk uh, putting yourself at a loss there of losing a huge percentage of your tenants overnight if that happens. So that's some of the downside of tertiary markets. Overall, to summarize what we've spoken about here, primary markets tend to equal stability, secondary markets equal balance, and tertiary markets are high potential reward, but also very high risk. They're more of a long-term cash flow play for local investors. So I'm gonna stop there for a second and open up the floor here for any questions. We'll take one, maybe two, before moving on to our next section of slides. Yes. Yeah, that's a very nuanced discussion. And I don't know that I have the perfect answer for that, but I would say that you could try and put, population or job growth standards, and try and say this is primary, this is secondary, this is a tertiary market. But more so, it's more of how does institutional capital and overall investor sentiment, what is that like towards that specific market? And you get a feel of that as you start to evaluate each of those markets. Now, a 30,000 population city is never going to be considered a secondary market. And so there is a threshold there. But when you're on the higher end or on the fringe, for example, if you have a city I live in St. George, Utah, and I would consider St. George, Utah a secondary market. And you have Cedar City, Utah, which is about 45 minutes away. I would consider that a tertiary market, right? But St. George, Utah is only about 170,000 people in population. And so it's not quite that 200,000 level that I described for a secondary market, but it's growing rapidly. And there's a lot of investment happening here. And it's got a certain degree of comfort from institutional capital, which is why I would classify it in as a secondary market over tertiary. But in Texas, you have many cities that have a population of 150,000 that I would consider more secondary just because of the lack of institutional interest. So yeah, I don't have a firm answer for you there. It's more of an overall feel of what's the outside perception and level of investment that's happening there, and who are the sources of that investment. I don't know if that makes sense, but everyone has a little bit different definition of what's primary versus secondary versus tertiary. Good question.
Hey, Paul, can you hear me?
Yeah.
Hey, Paul, in your first slide, you're talking about the smile state and then versus the cash flow markets. I think that's pretty interesting. Can you know why that might be that those markets that you show that were in gray, those have better cash flow? Is that because those are I mean, I see Texas, I never see Alabama, New Mexico. Is there a reason why those would have better cash flow? Those, what you said, were growing, and it looks like the purple are older markets because you have the Northeast, maybe a bit older cities. Is that possible?
Yeah, that's a good question. I don't have all the answers. I just know that historically this is how these markets have acted. But you have these major cities that are really the growth cities. So, for example, Dallas Fort Worth is growing like crazy. Miami, Florida, and Tampa, Florida, they're growing like crazy. And so when you have hot markets, those are places that people want to live. And so you get massive influxes, which drives up demand and drives up prices. And so usually the coastal cities, the mountain states, with great economic an economic establishment, so existing jobs there, and then the some of these Sunbelt states, you see large population influxes, which is where you see comfort level with institutional investors and buyers. Now, how often do you hear about how people are moving to Nebraska in droves, right? Or Kansas or Missouri. Those are less uh, desirable states just from an overall sentiment. They are growing, but it's not the same as people wanting to live in Savannah, Georgia, or Miami, Florida, et cetera. And so you get a lot more stability and predictability because there's not these massive swings in demand of people are moving in and buying assets, and then now the economy's down, and so it's struggling a little bit more, which is why you get more opportunities for good cash flow plays because predictability and less influx and investment of population tends to play well for that. I don't know if that
Perfect.
helps answer
No,
your
that
question.
explained it. Yeah, that I didn't put that together though. The rise in demand is going to cause higher prices. That was lead to appreciation. Thank you. I appreciate it.
Thank you for the question. Okay, so let's move on with the presentation here. We'll be talking about how to identify which markets are growing and which ones are not. Now, some of this is going to be really easy. You can Google very quickly population trends and how certain markets are performing. But we're going to try and go into a little bit more depth on this. There are essentially three different factors that we need to be considering. There's people, jobs, and capital. From a people standpoint, what you're looking at is net in migration. This goes to what you asked here, Stuart, of your smile states. Well, those smile states tend to have the greatest net in migration, and so you have greater fluctuations in population coming in here. When you see cities that have consistent net migration over time, I like to look between 5 and 10 years, and usually cities that are north of 0.75% to 1% are that sustain that over a 5 to 10 year period are good cities to invest in. Now, it's important that you focus that because if you have it growing 1% a year, but an example of this would be Quartzsite, Arizona. It's a small little town in Arizona. Well, every summer the population grows from about 4,000 people in the summertime, and then once they go to the winter, their population increases to about 200,000 people because of all the snowbirds coming down to with their RVs. Well, that's a great population, but I'm not going to want to build an apartment complex there, right? So population on its own is not necessarily as important as identifying how permanent is that population, and age is important. So the most important factor of the population growth is you want to see people ages 25 to 45 roughly, that are moving there and establishing it. So you know that this is a long-term window of this population that's moving into an area. The last thing is affordability relative to feeder cities. So as the US continues to have a housing affordability crisis, you're going to have people that identify edges. So where can I live and buy more and be able to live more affordably? And more often than not, the answer to that is you can't do that within a larger primary market. And so you're seeing trends more towards growth on secondary markets that still have all the amenities that you need for the most part of a larger city, or they might be close proximity, an hour to an hour and a half, 2 hour drive to a larger city. But you're living remotely, a little bit further out from those larger markets, and being able to have greater affordability. And so
Some of
those
our
markets
buyers
tend to
outside of that community that want to
be
invest in.
more desirable than the very expensive markets that you're seeing happen in these large cities. Now, jobs, an important thing here, and I would say job growth is actually more important than net immigration, because if jobs are growing, then eventually the people are going to come. So you might have an area where it stayed relatively, maybe a quarter of a percent each year in population growth, but over the last 2 years, you've seen massive job growth. Well, eventually that's going to feed, and if jobs are coming into an area and economic investment, that's likely going to continue and likely going to ramp up the population and migration and demand that you have for a multifamily asset. Major employment announcements is also important. So this is something that people do often. They follow infrastructure improvement, and this will go into capital as well. They follow infrastructure improvement. They follow job announcements, factory announcements. Here, this picture on the upper right hand corner is of a new facility. This is a BMW facility in Spartanburg County, South Carolina. And this was announced a few years ago. It's a, I think I want to say it's like a $2 billion plant that they just put into here. It's providing 500 jobs locally. This is one of many examples in Spartanburg of new announcements that have happened in this area. And the job growth is outpacing the introduction of new housing product. So this is where we follow these announcements. We see Spartanburg's a great market, doesn't have enough product to support all the job growth that's happening in there. Well, we acquired a 244 unit multifamily development site in Spartanburg that we're raising money for right now. And so following growth and announcements is a great strategy for identifying growing markets and unmet demand. Other capital things to look out for are infrastructure improvement. So this might be widening highways, or creation of new highways and freeways. Follow big research. Now, what I mean by big research is you have large corporations that open retail and shopping centers, et cetera. Well, they put a lot of research into growth trends, and they know where people are going to be moving to. They know where things are going to be built out in the future. And so I know developers that only invest within a quarter mile of a new Starbucks location, or only invest near a Walmart location. It's because they piggyback on the research and success of these large corporations, and they're able to trust that research by putting that in there, and knowing that growth is going to come and there's going to be demand. So that's one example. Airport upgrades. So what's becoming a better trend lately is in secondary and tertiary markets, your airports are actually expanding capacity, which makes these more desirable locations for employers and new people that want to work remote or part remote. So that's expanding airports usually is an indication that both growth is happening in the area, and that's expected to continue to grow in a specific market. So that's a few examples of how to identify growing markets. There's plenty of markets all across the United States that are growing rapidly, and there's plenty of markets that are not growing. And so a little bit of upfront research will help save you a lot of time and a lot of money to identify really what the right market is to invest in. You don't want to invest in a market where the population is decreasing by 1 to 2% every year. That's just, especially as a multifamily product, you're not going to be successful with that strategy. Okay, let's move on here. So, investing local or remote, what is best for you? The answer to this question really depends on the individual. There are some where investing local is the best strategy, and some where investing remotely is the best strategy. Let's talk about the advantages and disadvantages of each strategy. So, as a local investor, especially in the tertiary and secondary markets, I would say the biggest advantage here is better deal sourcing. Everyone knows about the good old boys network if you live in a small town. Usually, most of the vast majority of deals are done by a small percentage of people. It's because they have the local relationships. They can get things approved and done and passed through the city that other people can't. They can find deals that other people can't because it's their uncle or it's their family friend that they've known for 30 years that just decided, I'm going to sell this land, but I'm going to do it to one of my friends. So there can be fantastic deals made and found when you're investing local to your community by leveraging the relationships that you have and have built over the years. More control. So this is an easy one. If I'm building a mile down the road, I can go visit that site and monitor progress anytime I want. I can't do that if I'm building, 3 states over. I have to plan out a trip, and there's expenses that come to that, and time and all that. So investing local is much better for site access and oversight. And I would say that where this really shines is for tertiary markets, because this is the only way, I won't say definitively the only way, but the primary way that tertiary markets are built and can grow is by local investors who have localized knowledge of that area and can take advantage of those opportunities where there's just a lack of interest from outside parties. Disadvantages of investing local include biased decision making. I've made a lot of money taking advantage of local biases. Um, and an example of this would be you grew up in an area for the last, and you've lived there for the last 30 years. You might have a certain neighborhood or street that has a reputation of having high crime, and I don't say this because it's my belief, but I've heard people say, oh, there's a certain demographic that lives in that area, right? And I'll come into that area and say, well, all the problems that they think exist there might have existed 20 years ago or 30 years ago. And that stigma or reputation has stuck with that neighborhood or area. But now I can see, well, there's a lot of changes in demographics that have happened. And you're starting to see different infrastructure improvements that are happening in an area. And you can see that trend that's starting to turn around for whatever the existing problems are. And if you take advantage of that, there's great opportunities from an outside investor. So that's a disadvantage from a local investor. You can make good decisions, or you can make positive decisions or negative decisions, all based on bias as opposed to reality and disciplined underwriting. Um, Another disadvantage investing locally is less scalable. If I'm trying to build a company, whether that's a development or investment company, then if I'm only limited to what's here in my neighborhood or my local community, it's going to be hard for me to really scale that company and grow it if I don't understand and learn how to invest remotely and go elsewhere. Unless you're living in a large primary market, but even then, your growth is going to have a ceiling unless you're willing to go elsewhere and to build out your company in other markets. And I would also say in primary markets, if you're a local investor, this can be quite competitive because there are a lot of people. You're competing with other local investors. You're competing with outside capital, and it can be hard to find good deals if you're unwilling to be flexible about where you're going to go for deals. Now let's talk about investing remote. There are some clear advantages here as well. Investing remotely gives you access to stronger markets, especially if you do not live in one of those strong markets. So if I live in a small town, but I want to build a company that takes institutional capital, I need to be building in larger markets, and I need to be willing to go to where those markets are. Portfolio diversification is another important one. We hit on this a little bit earlier as well, but if you're investing locally, then most of your portfolio is going to be local. And what if an event happens there that displaces a large portion of your tenants, or creates damage to your assets? If you have multiple assets in different areas of the country, then you're protected against that. Or what if one market tends to have a downturn, while let's say the West Coast might be struggling, the East Coast is doing better for multifamily. Well, if you have assets on both, then you mitigate that with your portfolio diversification. Another benefit here is the ability to follow growth trends. So if my strategy is I go and build multifamily every time that there's a new announcement for an Amazon fulfillment center in an area, I go build something in that area. Well, this allows me the flexibility to go and do that all over the country and to scale in that way, if that's my strategy. Scalability, obviously, the ceiling here is much, much higher if I'm willing to go and build out projects and investments all across the country, it just gives me more opportunities that I can evaluate and be really select the best of the best. And then there's less bias. You're making your decisions solely on underwriting as opposed to local perceptions. Then disadvantages for this strategy here is going to be less visibility. Again, we talked about this, but uh, you unless you're planning travel regularly or move to an area, it's going to be harder for you to have an on-site presence. You have to rely on third-party management and general contractors and people that are not you that are on site every day, and you have to trust that they're telling you what's right and what's actually happening. Now if you have a great team, then all is well, right? But there are a lot of dishonest people in both construction and management, and really any business you can imagine. And I've definitely had to go through some difficulties because the on-site team wasn't completely honest with me. So it is important if you are the operator to have boots on the ground regularly, even if it's not all the time. But if you're a third party investor, if you're looking to place capital with someone who is the operator, it's important for you to get to know them, their track record, and to make sure that there's consistent reporting happening to be able to mitigate risk and downside there. Um, so that kind of sums up the benefits and drawbacks of both investing locally and remotely. I hope that that's been a valuable discussion for you. Now, you might be asking, what's a good fit for me? Right? We've talked about a lot of different points that you should be considering in selecting a market. Now, there are four questions here that I believe are critical for you to ask when making this decision for yourself. The first is, what's more important for you? Would you rather focus on appreciation or income or somewhere in between? Primary markets are going to be usually a higher appreciation play. Tertiary markets, you're going to have some of your best cash flow and long-term income opportunities in those markets. Secondary markets will be somewhere in between. So, appreciation or income, which is important for you? How active do you want to be? If you're the kind of person that has to be on site all the time, have complete control, and do it all yourself, you're going to have a really hard time investing remotely. So you should probably try to look for investments locally. If you're comfortable with being more hands off, trusting a third party operator, or if you have experience in managing things remotely, then investing remotely is probably going to be a good play for you. What is your risk tolerance? Primary markets offer the lowest risk. Tertiary markets offer the highest risk. What is your risk tolerance there? And then what is your time horizon? So low liquidity versus high liquidity. If I want to build something and sell it in a short period of time, then I'm going to want to stay in primary markets, maybe strong, larger secondary markets. If I'm looking to buy something and hold it for 10 or 20 years and just get cash flow and pay that thing off, well, then tertiary markets and secondary markets, especially smaller secondary markets, are going to provide great opportunities for me there. So those are a couple questions for you to evaluate for yourself when deciding what is the best fit for you. Remember, conservative capital equals primary markets for the most part. If you want a balance between the two, secondary markets are usually your best bet. And if you want to focus on yield and hands-on management, then tertiary markets or investing locally is going to be a good move for you. So that's basically the presentation here. I'm going to share a little bit about how I interpret this for myself. And so I'm not recommending to anybody what you should do, but I'm telling you how I interpret the information that I have learned over time and what I've shared with you today. And for me, I tend to focus on secondary markets when I invest and develop. I'm a multifamily developer by trade, meaning I buy land and I build. And what I found is that a lot of these primary markets are overbuilt at the time, but the secondary markets are quite underbuilt because there's been such a big focus on building in the large cities with institutional capital. And so I found a lot of great opportunities in secondary markets. I've been able to lease them very quickly over the past few years in a market where it's been hard to lease assets. When you find the right secondary market, you get the best of both worlds. You get fast appreciation, strong liquidity, medium to strong liquidity, but you also find more opportunities and have a bigger impact on the community that you might have in a tertiary market. So for me, it's all about the balance, weighing both the high return, more opportunities while still mitigating your risks. Secondary markets is my pick for that. So I want to open this up to final questions. And I hope that this has been a valuable presentation for anyone that's listening live or listens to it here in the future. But what questions do we have? Yeah, that's a really good question because I've worked with some great teams. I've also been burned by working with some really bad teams. Now, there's two ways to answer this. From my perspective, I'm a developer, and so I'm hiring general contractors. I'm overseeing that work. From another person, maybe a listener's perspective, they're an investor that's investing in an operator. And so the first thing is track record. You want to make sure that there's a long history of performance from that group, whether that's an operator that you're investing in, such as myself, or if it's me hiring a general contractor. I want to make sure that that general contractor has experience and capability to and has done that for many years prior, and so that I know they have great reputation and are trusted in that area. Same thing with a third party property manager, and uh, especially with those two, local expertise for those. So if I have a company that I work with in Salt Lake City, I could have them move to and build something for me in Texas. But do they have the local expertise and sub relationships to be able to do that the best? Sometimes that can work, but sometimes you can create problems for yourself too. So local expertise is going to be important there. But at the end of the day, you want to work with trustworthy people, and that's sometimes hard to discover. That's discovered tends to be discovered over time by just working with enough people and sorting out who is who, and you get to feel out, who seems to be people who can act in integrity. So that's a big thing, but it can be hard. It can be hard to discover that. You want to mitigate your risk as much as possible. For example, if I'm working with a general contractor that doesn't have very much experience, well, maybe they'll give me the best price, and so there's a decision to weigh there. But usually, the best price isn't always the most qualified person. But if I have them uh, go in and bond the project, which is basically insurance policy that ensures that that project is going to get done either by them or the insurance policy takes over for them if they're unable to do it. Well, that can mitigate my risk while allowing me to have the reward of the lowest price and making that project pencil better, right? So there are a lot of decision making factors here. There's a lot of nuance in this decision, but I really try to find people who are organizations of integrity. They do what they say they're going to do. They communicate well, and once I find those people, I try to and repeat as much business with them as possible. That's a great question. Any other questions?
Yeah, Paul, I have a quick question. Um,
Yep.
I like one thing I really liked was I've heard a lot about net migration and looking to invest, but you're the first person to put the point on how permanent that population is. I've never heard that before. So I thought that was really good. My question is, what growth percentages would you consider high growth? So you do have some markets I see that are maybe 3 to 5%. I've seen those kind of be ignored before. When you're in these high growth markets, what would you consider like a high percentage growth per year, like 10% or even like 8% or something like that?
Sure. So I live in a high growth market. I live in it's a high growth secondary market. So St. George, Utah. We've got about 170 people, but I think it was growing at 2.5% year over year a little while ago. It's been a while since I checked those numbers. But I would say I would be cautious of any one-off performances. So, like the last year or 2 years, you might see something that's extremely high, but what's the last 5 to 10 years, right? So you want to see consistent performance over time. And if you have a city that is growing at 3% year over year for the last 10 years, you by all means should be investing in that city. I mean, there's other things that you need to be considering. So assuming all the other underwriting metrics work out, that's a great population growth trend. But there are very few markets in the country that grow at that level. Um, and just because it's not growing at 3% a year doesn't mean it's not a good investment. Normally, what I see as good is anywhere from 0.5%. I mean, it's average, but I would say anywhere from 0.75% to 1 to 1.25%, year over year over year on a consistent basis is a pretty strong market from a population growth growth standpoint. Some where you see the ultra high ones, it's usually smaller cities that something happened in that area. For example, rapid growth for the economy and job growth. But how sustainable is that percentage growth? That's really what you want to look at. It's less of what is the number and more of how sustainable is that over time.
Perfect, perfect. I had one more question. Just in these secondary markets that you see growing in your experience, have you seen any political risk? And what I mean by that is, I'm in Los Angeles, and so we have a lot of political risk when we invest somewhere. The politics and rents can change, and destroy your underwriting. In these growth markets, maybe there's local population that didn't want their place to be growing so fast. Have you had any experience with? Um, all of a sudden the laws in one of these secondary markets change because now they're growing and there's pushback against from the entrenched community.
Yeah, well, that's absolutely a risk when you're investing like this, and it depends on where you're investing. So California, for example, that's a much bigger risk than it is in Utah, where I live, just because politically it's a different approach. And so for my personal approach, I only invest in states that are favorable politically for what I want to do, and usually where you're going to see that as issues, even in some of these um, more conservative political states. Sometimes you see these large cities adopt rent control or just higher regulation for these developments, and so that's one of the reasons why I like to invest in secondary markets is because you tend to have less regulation and less control over that, and you're able to still meet an affordable price point, but also do it to market and be in control of your own decisions. So yeah, I haven't invested in places like California or New York, places like that that are highly regulated. That certainly does come with its own set of problems with the political environment and navigating those types of risks. But you certainly, if you're willing to invest remote, you can certainly find markets where that's a low risk.
Perfect, perfect. Thank you.
Awesome. Well, thank you, everybody. I appreciate your participation and the great questions. Stuart, thank you for the questions, and Ivan too. Um, I hope that this has provided value. If you have found this valuable, I appreciate your comments on this. I would love to hear from you. You can reach out to me by connecting on LinkedIn. You can message me directly there. You can email me at paul@surgeredev.com, or you can use this QR code here. You can book a call with us. We are always looking to help wherever we can. Um, if you have a deal you're evaluating, I'm happy to take a look at that for you. We also have plenty of opportunities for third party investment in the deals that we're building and develop. And so, if that interests you, reach out. We'd love to talk with you. As far as our upcoming webinars, we will be hosting a webinar. I believe it's the third of no, no, no. It's the 12th, is it, Ivan, of March? Is that right? March 10th. Thank you. I should know that off the top of my head, but I don't. I don't. So March 10th, we will be hosting how development deals are funded and financed, and then 2 weeks from that point, which Ivan, if you can give us the date there, we're going to be hosting another webinar owning the construction process. So this will be a dive into how developers manage risk and relationships while under construction, how we select general contractors, the different things that we do to create value during that construction process, all that. And that second webinar will be on Ivan on the 24th of March. So we would love for you to participate with us in both of those discussions. In the meantime, have a wonderful week. Thank you all for participating.